So an option basically, it's like a health insurance contract. So what I'm going to do is we're going to create an option, and I'm going to explain it to you in such a way so that you'll never forget it. All right, let's have some fun with this. All right, cool. So we're going to make an insurance policy, okay? And this will explain what an option is and how all this stuff works. Let me go up a little bit so you can see the bottom. Yay, here we are. Okay, so we're going to make an insurance contract together. So let's say I want to buy health insurance. And what I do is I call up State Farm or a health insurance company, right? And I tell them I want to buy health insurance. And so what they tell me is they say, okay, cool. We'll give you a 10-year policy, okay? So a health insurance contract is only for a certain amount of time. Okay, so we're going to make an insurance product here. So we've got an expiration date on the policy, which is 10 years. Then what they do is they look at my heart rate to see how good my heart is or bad it is. And if my heart rate doesn't go up and down very much, meaning it's not very volatile, then they make the price of the health insurance contract lower. Okay, so that's volatility. Then what they do is they tell me, hey, we'll give you this health policy, okay, in case you get sick, but we want to put a deductible in to make it cheaper for you. Okay, cool. Right, so they have a $100 deductible. And what that means when it comes to health plans is if I get sick, God forbid, and I go to the hospital, the first $100 I have to pay for it myself. Okay, so that's basically how it works. And so with a health insurance product, if my heart rate is really, really high, right? If it's really volatile, then of course the price of the insurance product, health insurance, is going to be high, right? If I have a high deductible as well, then what happens is the price goes down, and then also there's an expiration date. Okay, with that in mind, what we're going to do is we're going to create an option. Okay, and an option is a call option first. It's very similar to a health insurance product. So when it comes to an option, what we do is we have the expiration date as well. And an option will allow us to put a little bit of money into an investment. And if the stock goes up a lot, we make several times that. Okay. But if the stock goes down, all we lose is whatever we put into it. So, so what we do is, first of all, we have the expiration date. So options have a finite life. Right? So quite often you buy a 30-day policy for an option. Then what we do is if the stock goes up and down a lot, you're going to buy the option on, the option price is more expensive. Okay. Then we have, just like we have the $100 deductible price, we have something called a strike price. Okay, I got to figure this out so you guys can see this better. We have a strike price. And so what I'm going to do now is I'm going to show you two props, and then I'm actually going to walk you through, and we're going to do a real options trade together. Okay. So with options, what you can do is you can actually make money if the stock goes up. Okay. That's offensive, right? And that's buying a call. So all that health insurance stuff I explained was buying a call. Now, what you can also do with an option, you can buy a put, right? Which is defensive. But it's defensive because you can make money if a stock goes down, and that's called a put. Okay, now with options, all you lose if you buy a put or a call, put you make money if the stock goes up, call you make money if the stock goes down. All you lose is the amount that you invested. Now, you also need to put in the stock price as well if you're going to price an option, and there's other things as well that I'm teaching in the course that I won't bring up today. So let's buy a call option right now. And what we're going to do is we're going to buy a call option on Coca-Cola. All right, so what we're going to do is we're going to type in here KO for Coca-Cola. Okay, so here we have Coke. And then what we can do is we can actually buy options on Coke if we wanted to. Now, what we see here is we see what's called an option chain. Okay, so Coca-Cola right now, and by the way, everything I do, you can also do it on Yahoo Finance, okay? And I don't want you to pay for any products ever. Thinkorswim is free to use. Yahoo Finance is free to use. So if you type up any ticker, what you'll see is if the company has options, and this is Coca-Cola's ticker, you click here on options, okay? And then you've got here all the options you can invest in. Okay, so this here, and they're always, the way it works is most of the time options expire on Fridays. Okay, so here's a bunch of Fridays here, most of the time, but there are exceptions. And so what we're going to do is I'm going to bet some money right now that Coca-Cola, and I'm just making this up, I have no idea what the stock's going to do, but between now and about a month from now, meaning November 12th, I think Coca-Cola is at $55 now. I think Coca-Cola is going to be, it's going to go up a lot, way above $55. Okay, so I will buy a strike price call here on Coca-Cola. And what that means is if between now and the 12th of November, if Coca-Cola goes above $55, I make a lot of money. Okay, so I pay this much money for that right. The way options work is with each options contract you buy, it's silly, but you have to multiply it by 100. So I can pay $8.10 right now to buy a Coca-Cola November 12th strike, 55 strike. And that means if by November 12th, when this expires, remember there's the element of time, by November 12th, if this expires and the stock of Coca-Cola is say $60, then I make several hundred times the money I invested. Worst case scenario, if it's below $55 by November 12th, I lose just this amount here, which is 81 cents times 100. Remember, options, they're always in lots of 100. Okay, so let's go back over here now. Let's actually place that trade. So what you can see here is when you type in the ticker Coke, you see all these dates listed here, kind of like what we just saw on Yahoo Finance. And so if I click here, what I can do is I can go to the 55 strike right here, okay? And right here, these are calls, meaning I make money if the stock goes up, or on this side, they're puts. I make money if the stock goes down. Let's just do a call. It's easier to explain. Okay, so let's go here to the 55 strike, okay, for Coke. And right now, if I want to buy it, the bid and the ask is 79 to 89. And you only want to buy options or any stocks where the difference between the bid and the ask is quite narrow, okay? Otherwise, you get a bad fill. So you right click here, and I'm going to buy an option. And what you can do is you can buy a single option, or you can buy something called an iron condor or a butterfly, which basically means 4 different options. And the profit chart looks like this. That's what an iron condor looks like. And I teach all this in my options course coming out soon. But we're going to buy a single option. Okay, here it is. All right. So what we see here is the option, a single option of Coca-Cola. It's one contract, which acts like 100 shares, hence 100 hockey pucks. It expires on November 12th. Okay. It's a strike price of 55, meaning if it goes above $55, I make money. And what I'm going to do, and you can select, and you can't see this under me, what exchange to trade it through, and to make it a market order or a limit order. I'll just do a market order. I'll keep it simple. So I click confirm and send. Now this is important. Before you ever buy an option, you need to understand the most you can make and the most you can lose. So this option, if I buy it, it looks like I'll get filled, and this is pretend money, at $83.50. Now remember in Yahoo Finance, we looked at the price of this option, and it was 81 cents, last price. So remember, you multiply it by 100 because you buy it in lots of 100. So that's $8.10, okay? Or pardon me, 81 cents times 100 is $81, sorry. Okay, but right here it's $83.50 because I'm not getting the best price. So it's going to cost me $83.50 to buy this, plus commission. And the most I can lose, right? The most I can lose is what I paid for the insurance policy, meaning what I paid for the option. Okay, it's right here. Max loss is $83, whatever. The max profit is infinite because if the stock goes up, and there's no limit on how much the stock can go up, you can make a fortune. You can make hundreds and hundreds of times your money with options if you do it right. Okay, great. So I'm going to click send. All right, let me turn the volume up here. There you go. It got filled. So now I own this call.